Eurodollar seems to be somewhat stuck around the 135 level. The question is, when will the pair actually budge?
I think the big turning point for Eurodollar was always going to be a change in US interest rate outlook when we start to see financial markets price in tighter Fed policy. Now, Janet Yellen's not doing anything to encourage us into pricing that anytime soon. I suspect that we'll see a slight acceleration in the US economic data at the back end of the summer. Perhaps the inflation rate will continue to tick higher, and who knows, we may even see some wage growth once we get through the school year and the new jobs, people coming in and starting in August, September. So I think we'll see high US 2- and 5-year interest rates from September onwards, which will start a process of taking Eurodollar lower. But it's going to be driven by the US side at this point rather than by anything in Europe.
And looking at the dollar now, it hasn't made quite the comeback that analysts were predicting a few months ago. Kit thinks it's because they were jumping the gun.
Well, a lot of people were bullish of the dollar on the grounds that the US is going to raise interest rates at some point. And of course, unfortunately, no one really thought the US was going to raise interest rates this year. So everyone was positioning for something that's actually more likely to happen next year than this year. So I want to be bullish of the dollar as close to next year as possible, which, historically 3 to 6 months before interest rates start going up is when you see currencies react and the front end of interest rate financial market yield curves move. So that's really why the September period seems to me the time to be bullish of the dollar.
So Kit plans on being bullish going forward, but beware.
For now, if you're a saver in the United States or an investor faced with extremely low returns on domestic assets, what are you doing? You're putting more money into emerging market assets. You're hoping that things don't get worse in Iraq. You're hoping that oil prices don't spike higher. You're hoping there won't be a hard landing in China. You're hoping there won't be more tension between Ukraine and Russia. And by and large, that strategy has been working for you because you've been doing better than if you stayed at home. What changes that? Well, any of these big risks, sort of geopolitical risks could turn up, but most likely what will change it is the level of US interest rates over the course of the next 2, 3, 4 years. But I wouldn't want to invest too soon in the belief that there is some sort of automatic rise in US rates that must happen. I'd like to see it first, please.